Question of the day. Do you have to pay capital gains tax on inherited property? Stick around and find out. Hi, I'm Bill Eaves with RE/MAX, and I sell mostly estate sales. So to answer the question directly, yes, you do have to pay capital gains on inherited homes under certain circumstances. You don't have to pay them every time, but it is important to understand the concept of capital gains with inherited homes. So first things first, capital gains tax is what an investor pays when they make a profit. Yes, the government taxes everything. So if you make a profit on an inherited home, it will fall under capital gains, even if you're not an investor. Now, 4 taxes affect what you get from an estate. The first thing is inheritance tax. That's charged by the state of PA. The second thing is estate tax, which is charged by the federal government. And that's anything at this point in time over $11.4 million. Next, there's income tax. Income tax is both state and federal. Just because a person passed away doesn't mean they don't have to file taxes. You still have to file, as an executor, you still have to file that final tax return. A qualified attorney or accountant will help you out with that. And the fourth thing would be, of course, capital gains tax. Now, at this point in time, I always try to say, seek the advice of a professional because your circumstances may vary. So when paying capital gains on an estate, there's something called a step-up value. Normally, if you're an investor and you buy a house for $100,000, you sell it for $150,000, $50,000 is your capital gains. Now you do deduct things that cost you to buy, cost you to maintain, and things that cost you to sell from that $50,000. But for the basic gist of it is a $100,000 purchase, a $150,000 sale is $50,000 in profit. So now you're thinking, wow, I inherited this property. Mom and dad bought it in 1965 for $15,000. I just inherited it for $300,000. I'm going to sell that and have to pay these capital gains. No, the step up means that, it's good news, the government finally giving you a break on something. The step up means that it's not what your folks or the decedent paid for the home. It's what the fair market value is at the time you inherit it. So back to the scenario, if mom and dad bought it in 1965 and you're inheriting a $300,000 property, that's called the basis. It's called stepped up from where the original purchaser bought it. Now, this is for houses that are considered primary residence. Even if the decedent was in a nursing home for a while, if it's still considered a primary residence, these are the rules that apply. If it was an investment property for them, you get slightly different rules. And again, that's where you really want to take that detailed information up with an accountant or a qualified attorney. Another question I get is, can having a trust avoid capital gains? Some trusts do, some trusts don't. The subject of trusts and taxes and inheritance is way beyond the scope of a video, so seek professional help if you have questions with that. So the next question that you should be asking is, how do I get around capital gains? Is there a way I don't have to pay capital gains tax on my inherited property? Yes, I'll give you 3 ways. Number 1, if you want to keep the property as an investment, you can at some point sell it and go into a 1031 exchange. Again, way too complicated for a video, but it basically means you're going to take the capital gains, reinvest it into a similar property, and just defer the taxes. If this property is an investment and is coming out of a 1031 exchange, again, talk to an accountant, talk to an attorney, get some detailed information for your particular set of circumstances. Don't just go buy a video on YouTube. The second way you can avoid capital gains on an inherited home is if you sell within a year. Within a year of the decedent's passing, the home is not subject to capital gains, regardless of the difference between what the market value was and what you sold it for. So less than a year, it's not subject to capital gains. The next way to avoid capital gains is on a primary residence. If you move into the house and use it as a primary residence for the next 2 years, or going back 2 years, you can exclude up to $250,000 for a single person, $500,000 for a married couple of gains on that house. So 2 years, it has to be your principal residence. And again, there's details involved with that, so make sure you seek the advice of a professional. If you're thinking about selling an inherited home or an estate home, there's a lot that needs to be done. Look below for my video on how to get it done the fastest, the easiest, and for the most amount of money. Thanks for watching.